Hey, so what we're going to do is walk through how I run my short-term rental numbers when I'm considering buying a property. Today we're going to run through this property here. And so I've already kind of plugged in the numbers, but I'll walk through exactly how I came to each number. This calculator is really easy to use, and I really like it because it gives you kind of more of a full perspective of real estate investing in general. It considers depreciation, it considers, cash flow, it considers debt pay down, and then appreciation over time. So I really like it because it's more of a full perspective versus just looking at cash flow only, which is important, but it's not everything. So first is everything in blue is what we fill in. First is the sales price, and I've already plugged it in at $450,000. It's listed for $480 right now, which I think is really high. And they did a price drop of $40,000, so it seems like they know that they're a little high, and they're pretty motivated. So first is the $450,000 in the sales price. Second is going to be your revenue. So I have a low and a high. So you see the low and high here. 3750 is, I think that's, I think I did it for 40,000. Yeah, 45,000. So that's a low. And then I also did a high of 60,000. So 45,000 here and 60,000 to give you kind of a, worst case scenario and probably a best case scenario on the property. And the reason I did that is I go to a couple places, and the first one I go to is AirDNA. So on AirDNA, you can create an account for free, and then you go down to the Rentalizer tab, and then you plug in the address, and then you can up and down the number of guests, number of bedrooms, but they're giving it a $58,000 annual revenue, which is pretty good, and I think it's probably pretty fair overall, but I like to look at a couple different places. The other one I like to use is Price Labs. So you can have a free trial, but I usually I have an account, and then I just pay per address I'm running the analysis on. So what you do is I'm just going to kind of step-by-step log in real quick. So this is what comes up at first, and you want to go to Market Dashboards. And so I created one for 17605. And they're $10 for every one of the addresses that you put in, but it's well worth it, and you can really deep dive into properties that are already being ran as short-term rentals, and then kind of you can literally click into a property that's doing well. So what I've done here is I have created the dashboard, and I've kind of plugged in and looked a lot closer. The property's sitting right here. And then you can look at red is they aren't doing really well. Green is doing, darn well. And then a dark green is doing really, really well. So you can kind of, plug in and look. So their average price is $225 over the year, and then if you look right there, it's revenue the past 365 days is $61,790. So that would be a property running really well. What's cool is I can literally click this. Oh, I clicked the wrong one. Literally click this one, and that is a very similar property to what we're looking at of purchasing. So you can look at their pictures, you can look and see what amenities they have, you can literally look at everything. Look, they have a little hot tub, which probably does, allows them to do really well. But it's a 2-bedroom, and it's making $62,000 and made it $62,000 last year, which to me is really good. Last year, our numbers were down compared to 2021, and we're even down compared to 2020. So already this year, it's May. The first 4 months it already eclipsed what we did in 2022. So for them to have done $62,000 last year, this property does really well. But also you can look at properties that aren't doing as well. Say we go into, they're doing $63,000. They're doing $14,000. Pictures aren't as good, older furniture. Maybe they have incredible high fees. You just want to take a deeper look into what your competition is going to be when considering. But that's why I did a low and a high. I think the high is a lot more comparable to what you would get for this property. But I like to really deep dive into their revenue and what the possibilities are for property. Okay, so that's it with revenue. Next is going to be the property taxes. And I myself, as well as other investors, have gotten caught up on this. So what I want to do is show you last year's taxes, which were $5,400 for 2022. And with the massive appreciation that we've had over the last couple of years, tax bills are coming out and they are much, much higher. So every time I run a property, I actually run it on the tax rate and not what the taxes were last year, because Galveston CAD's going to come back and they're going to go, hey, I see that you bought it for $450. We had it listed for, $350. And so your tax bill just increased to the $450,000 value. So really quickly, I'll run that number just so you know how I got it. 0.19875 times 450,000. So that's that 8,943. So 5,400 or 8,900. That completely changes your cash flow. So that's why I run it like this. You may get away with it for about a year of it being lower, but that's going to catch up with you over time. So I'd like to run the numbers at worst case scenario, and so that's why I plugged that in. So I put 8,943 here. Insurance a month. So I went and asked the other agent to give me their insurance declarations, and it came out to be about $3,500 per year for, and on Galveston Island, you have to have windstorm, you have to have flood insurance, and then you have to have like the standard hazard insurance. So those calculated up are about $3,500 a year. So I divided that by 12, and that's what you get there. Gas and electric can vary. It seems like a pretty small property. So I put in a 125. We could always ask, you can always increase that, but that was just a rough estimate. Dynamic pricing, I highly suggest it. The Price Labs, they do dynamic pricing as well. They usually take a percentage of the revenue. Highly suggest it just because they're going to be able to see, there's festivals or anything coming into town, they're going to naturally increase your prices and decrease your prices for you, so you don't have to keep up with that. Highly suggest dynamic pricing. It pays for itself, I promise. Internet consumables, that should probably be increased to about $75 a month. And then HOA was $455 for this property, and I'll show you where I got that. Or $445 per property, or for this property, so. And then management, so we manage ours ourselves. I've got a couple of property managers that can manage it for you. I highly suggest at least starting out to manage it yourself, just so you know how, the types of questions that you're going to get, and just kind of understand short-term rentals and the management side of that. So if you do hire a property manager, you know what you're looking for in that property manager. So for now, I'm leaving it at 0%. You can plug that in, as you see needed. Vacancy, that's already calculated in the AirDNA and the Price Labs estimates. So I leave that at 0%. That's more for long-term rentals, but it's there if you need it. And then maintenance, because this property is a townhome and the exterior building and the grounds are both taken care of, that really reduces the maintenance that you have to upkeep with that property. As well as water and sewer that was what was here, water and sewer, and I completely deleted it because it is included in this property. So maintenance I put as 5% because normally, older buildings, houses, something that isn't a townhome, I'd increase that, 8-10%, also depending on the age of the house. So that's variable and can be changed. Next thing is going to be your mortgage. Down payment, if you're planning on putting 20 to 25% down, you can change that there. Interest rate, whatever your interest rate is, plug that in there. Loan term, highly suggest 30. If you can get like a 35-year, 33-year, do it. Just makes sense. And then your closing costs, probably going to be around $8,000 for this price of this property. So now the fun part. The pro forma, I'll just get a little deeper here. So you've got gross rents on the low and then cap rate is more for commercial properties, but over here you can look at your return on investment and then your monthly cash flow. So cash flow is there. So if you don't run your Airbnb well, it can be at a negative cash flow of $414,000 or $414 a month, with an annualized loss of $5,000. For a high pro forma, that's going to be your $60,000 property, which we saw on Price Labs is very attainable, and multiple properties are doing it, and doing it well. You're looking at a $775 per month cash flow and an annualized net of almost $10,000, which ROI of 7.7, pretty darn good. But that is self-managing. So that's kind of a, good analysis of kind of what to expect as far as cash flow. So the next thing I like to look at is your debt pay down, because it's important. And that is another huge factor in, investing in short-term rentals, investing in long-term rentals is, I'm at the point where I have properties that are now paying for other properties, and I don't have to necessarily put more cash into my investments. So this debt pay down, you can later use home equity lines of credit. You can do a cash out refinance. This is where that snowball starts building. And I think it should be considered in that first property, because you need to look at this long-term and big picture and not just cash flow today. Cash flow is important, but it's not everything. So, over the first year, you're going to pay off, $3,500, and then that increases over, and I'll show you where that flows into the next calculator down below. Here's your debt coverage ratio. You can look into that. Obviously, it's just making sure that you're covering everything. Depreciation, which I love. So talking about depreciation with straight line, and then your total interest paid that you can write off. So that will calculate and give you your tax savings per year. And then what you want to do is, in order to get that calculation to go, you need to put in your marginal tax rate, which mine is, I think it's 35%, and then your improved value. So assessed land, you have to assess value, and you have to remove the land. So what you want to do, and I can get this number for you, if you go to tax, and total value of the land is very little. So we could just say maybe like 5% here, or 95% of the improved value. So there you go. There's your depreciation the first year, total interest paid. There's your annual return on investment on tax savings, which is also to be considered. And then over here, you can do annualized appreciation. So let's just say, because we've had such a massive appreciation, let's just put 2% over the next 5 years. Even then, you've got an annual gain of $9,000, $10,000 over the next, so $50,000 over the next 5 years, which is fantastic. And then the last thing, which we all know, that rent is increasing with the, with rent right now, everything's going up, right? So what you want to do is, for here, I would say it's at least 5%, maybe even higher, but let's leave it at 5% for now for that. So the total return on investment here is what I really like to look at, right? So you've got your total return in year one, you've got $34,000 in year two, which is a 30% cash on cash return of your investment. Year two, 31, year 5, 32. But I mean, this is the true value. You've got, your cash flow is important, but all these other numbers are really what you're holding that property for. So you're averaging about $35,000 net profit, total return on your property for this property. So, and that's just about it. If you have any questions, obviously reach out to me or anything. But this is my calculator, and this is how I run my short-term rentals.